Nice to meet everybody. My name is Spiro Antonopoulos. I am the Vice President of Client Solutions at Solidus Labs, and I want to thank the GBBC for the kind invitation to let us tell our story. Solidus was founded in 2018 by two ex-Goldman Sachs engineers who recognized at the time, and this was sort of on the heels of the big boom in 2017, that there was nothing in the space of surveilling for market integrity and market abuse. Out of the ashes of Mount Gox came a lot of great first-generation blockchain tracing and investigation companies. So AML and CFT was starting to develop a muscle from the perspective of both market participants and law enforcement, but there was really nothing in the space of market integrity. And I was actually sitting next to them starting my first crypto startup, Cash, which was trying to build out payment rails on Bitcoin for sub-Saharan Africa. So that's how I met these folks. But they started in 2018 building out market integrity solutions, which has then morphed into comprehensive risk management, which I'll talk about. So today we have more than 60 clients across exchanges, broker-dealers, OTC desks, banks, and regulators who are using our trade surveillance, transaction monitoring, and threat intelligence software. Speaking of regulators, well, one thing I'll say about regulators is that they work with us in multiple different ways, really based on the limits of their authority in their particular jurisdictions. We see certain regulators mandate very specifically what data should be shared with them, either in real time or end of day, to give them the ability to surveil the markets as they see fit. And we see other regulators that really just want access to our algorithms that run on public data and also on-chain DeFi data so that they can see anomalies and then decide how they want to follow up with their licensees as part of their supervision process. I won't focus on this today much, but important to mention that we have a young but growing investigative services practice that really sits at the nexus of smart contract and protocol analysis and economic analysis. And so some of what we do is we help enforcement teams at different regulators understand at a layer deeper than maybe they have the expertise or bandwidth to what's going on in this particular protocol or set of smart contracts that may either indicate a geographic nexus or a nexus or a sort of vector for centralization where there may be ostensible decentralization. We do a lot of work with a tool called Token Sniffer that was originally built as a retail-facing tool to help traders not get rugged by new token contract deployments. But we use that internally to support law enforcement in scam rings. And we've seen that certain contract employers are deploying code-based rug pulls at scale to the tune of many millions of dollars in proceeds. It's what we call death by a million cuts. And part of our work is not just scanning blocks for these programmatic rug pulls, but also helping investigators understand where there may be serial scammers, even tied to nation states in some cases. We also help with insider trading investigations. I have a use case to talk about that a little bit later. And then market manipulation, where there's a particular activity that requires expertise around an event that we support the investigation of. So when we came to this space, there's a lot of talk about how crypto's no different than traditional markets. And in many ways it is, but in many ways it isn't. And so one of our mantras is that we are a crypto native solution, and we think that's very important. It's important because there's engineering challenges when it comes to surveilling crypto markets. There's no Reg NMS in crypto. There's differentiated data standards. It's great that there's growing interoperability of blockchains, but there are significant challenges from a latency perspective, from a pricing perspective, from a data standardization perspective, that we just haven't had enough time to evolve into these standards in crypto markets. And that creates engineering challenges for surveilling these markets. Also, the market structure is different. Retail and institutional participants interacting on the same venue. In instances where we have market participants that type of silos and segregations that you have in traditional markets between custody and trading, between prop trading and agency trading, and that creates new patterns of manipulation and new vectors for risk. And then we already talked about it. Some of my esteemed colleagues mentioned the composability of crypto and the fact that this can create risks as certain aspects of the stack can be centralized, whereas others can be centralized, and each of them have their own unique risks inherent to them. And so, given this sort of unique nature of the crypto ecosystem, we built our product to truly be crypto native and to truly think about cross-chain surveillance as critical to a healthy and orderly functioning market. And what we mean by cross-chain is on and off-chain. Now, people may be surprised to hear this, maybe not in this room, but about 80 to 90% of transactions in crypto happen off-chain and I'm not even talking about permission chains, but just on the ledgers of centralized providers, broker-dealers, as opposed to on DEXs or on-chain. And so what this means is that you can't just look at on-chain data, which we bring into our solution, but you have to look at the private order book of market participants. You have to look at other off-chain data like news data, which traditional markets and traditional surveillance solutions have perfected in many ways. You also have to look at the money in and the money out to look at those transactions that are coming in and funding some of these trades. And so we bring all these into what we call our crypto native market integrity hub. Platform is called Halo, and now it's evolved into 3 modules: trade surveillance, transaction monitoring, and threat intelligence. And what we do is we enable compliance and risk teams to manage across all those different areas. In some cases, based on the particular arrangement of that market participant, they only have trade surveillance or they only want to look at transaction monitoring. But we give them the ability to deploy our solution as lightweight or as comprehensively as they wish. And this sort of under the hood means that we're surveilling across dozens and dozens of rule-based, machine learning-based, and programmatic algorithms that cover AML, CFT, fraud, as well as any price and volume manipulation and marketplace monitoring that is necessary for trade surveillance. And then a new and emerging area, which is what we call on-chain threat intelligence. And this is anything that's happening on a DEX, which could be programmatic, could be inherent in the code that's basically designed to steal user funds, or it could be traditional manipulations like pump and dump or like insider trading that are happening on DEXs, but which are happening because of the sort of veil of pseudonymity that these DEXs provide. And so this is our market integrity platform, Halo, providing these 3 areas. But really, I want to spend the rest of the time talking about, and I've been told I have a lot of slides, so we may only get through 2 of these use cases. But when we try to sort of live by our mantra, by helping our clients and by helping regulators monitor cross-chain, across off and on-chain, across public and private data, there are a few use cases that sort of exemplify this mantra. One is the work and the research that we've been doing around insider trading that's happening on decentralized exchanges. And then the second, which I'll have time to talk about, is our work in helping institutions stake safely with our solution staking guard. The name might change, paying homage to the JPM. I don't think we're experts at naming things either. So insider trading on DEXs. We conducted research, and we published this maybe 8 to 12 months ago, where we looked at a 17 or 18 month period in 2021, 2022. And we identified that over half of the ERC20 token listings had signatures of insider trading. And we set a pretty high bar for what we called insider trading. And moreover, over half of these insider wallets were serial actors, where they acted more than one time across more than one token listing. And in fact, about 10% of them acted multiple times, 5, 10, 12, 18, 25 times. So there were some actors with significant access to listings on major exchanges that are obviously part of what's hurting the integrity of these crypto markets. And then the last point is that about a quarter of these were connected to centralized, in many cases, very well-regulated exchanges, either because the exchange was the funding party and that pseudonymous wallet was funded from a regulated exchange, or it was the offboarding point. And so how this looks, really, this is one that we have a safe enough distance from to talk about, but Binance's TBK listing in February of 2021. You can see the red here, just a very simple price chart. The wallet bought 3 days before the listing announcement at a favorable price, represented by the green arrows. There was the announcement, and then the price spiked because, of course, there was demand from the announcement, and the bad actors sold very favorably, even above the price that we get from this particular set of DEXs that we pulled in. And we estimated that this particular actor made more than 200,000 from just this one trade. This is a big problem. It continues to be a big problem. It's a concern of regulators. And in our opinion, it should be a concern of regulated exchanges as well, since they are in many cases unknowingly the recipients of these ill-gotten funds or funding these bad activities. So we've developed a tool. Did you already put up the 5 minutes? So let me talk about staking guard. So with the Ethereum upgrade from proof of work to proof of stake, a new ecosystem has emerged. And we've worked with a few of our institutional clients that on this ecosystem chart will be that last box, the validators. The validators are the ones that lock up their ETH or their client's ETH in return for securing the network, which of course means a lot of things. The ecosystem includes the users, which are at the front end expressing their intent to do something, to buy an NFT, to make a trade. The searchers that are like the HFTs looking for these very profitable trades. The builders that have the specialized infrastructure to build and arrange these blocks and orders and propose them to the validators via the relays. There's about 100, 150 builders and about 8 to 15 relays right now. What we ask is, as an institution, you should care who builds your blocks from a counterparty risk perspective and what's in your blocks. And who builds your blocks means these 100 builders, are they bad actors? Do they have good practices for risk management? What's in your blocks? CSAM, illicit finance, hacks, exploits. There was the famous Curve exploit in July of 2021, in which Coinbase received a significant APY reward based on hacked funds. We believe that this is going to be a new area of risk management where clients are going to want to be, they're going to want to have the ability to screen these transactions, but also to be alerted on transactions that they don't necessarily want to screen, but that they want to investigate, potentially return funds. And so as a result, we built through a partnership with a major infrastructure provider in the space, our own builder and our own permissioned relay, which is sending clean blocks to be validated by validators. And again, we're building this in partnership with 2 particular institutions. We think there's going to be significant institutional need for this. And regardless of where the discussion goes across the globe of where a validator sits from a regulatory perspective, we know that the institutions that are custodians are also going to want to ensure that they're doing this type of risk management. So thank you very much for your time. It was a pleasure to be here.